So you're 18, fresh out of high school. You've made it to college. Your ticket to freedom, opportunity, and apparently debt. Picture this. You're walking through freshman orientation. Between the student clubs and free pizza, there's a table with friendly representatives handing out t-shirts. All you need to do is fill out a simple form. What they don't tell you is that this seemingly innocent exchange is the beginning of a carefully orchestrated trap, one targeting you at the exact moment when you're most financially vulnerable. In 2024, 65% of college students have credit card debt, with an average balance of $3,280. Credit card debt is now 6% more common than student loan debt among college students. This isn't an accident, it's by design. Credit card companies don't just want your business for 4 years. They want it for life, and they're willing to pay universities millions to help trap you in a cycle of debt that many students will never escape. This is how credit card companies turn college students into lifetime profit centers. Long before credit cards were ubiquitous, there was the Diners Club card, started in 1949 by Frank McNamara. It wasn't a true credit card, it was a charge card. You were expected to pay off your balance every month. The banking industry quickly realized the real money wasn't in convenience or transaction fees. It was in debt, specifically long-term debt from customers who could only afford to make minimum payments. A college freshman who signs up for their first credit card represents a potential lifetime value of tens of thousands of dollars in interest payments alone. Industry research shows the first card a consumer obtains often remains in their wallet for decades. Here's the genius part of targeting college students. Even though they typically have little to no income, they're still profitable targets because many have parents who might bail them out if they get into trouble. This safety net reduces risk for card issuers while still allowing them to charge astronomical interest rates. The partnership between credit card companies and universities runs deep. In 2022 alone, credit card issuers paid over $19.6 million to colleges and their affiliated organizations for access to their students. That's an average payment of $138,000 per partnership. This isn't charity, it's an investment with an expected return. These partnerships create a fundamental conflict of interest. Universities are supposed to protect their students' well-being, not profit from their financial vulnerability. As the Balance Money reports, if you see a credit card company on your campus, they've likely paid your college administrators a fee, sometimes millions of dollars, for the ability to market to you. Colleges also get a kickback from every credit card opened and sometimes a percentage of charges made. Many schools even offer co-branded cards featuring their logos and mascots, lending institutional credibility to financial products that may not be in their students' best interests. Credit card companies don't just sell plastic, they sell a lifestyle, freedom, independence, the ability to have what you want when you want it. Their marketing precisely targets the psychological vulnerabilities of college students, the desire to fit in, establish identity, and experience adult freedoms. Before the Card Act of 2009, credit card tables were as common on college campuses as textbooks and coffee. Companies would entice students with free pizza, t-shirts, and frisbees in exchange for completed applications. While regulations have changed, the targeting hasn't stopped. It's simply evolved. Digital marketing now follows students across every platform they use. Targeted Instagram ads featuring peer influencers make credit cards seem like an essential part of college life. But the most insidious aspect of credit card marketing isn't how they acquire new customers, it's what happens next. Credit card companies have mastered the art of extracting maximum profit through what behavioral economists call anchoring with minimum payments. Think about it. When you receive your statement, what's the most prominent number? Not your total balance, not how much interest you're accruing. It's the minimum payment, often just 1 to 3% of your balance. This isn't a coincidence. By highlighting the minimum payment, credit card companies psychologically anchor you to that amount. Research published in the Journal of Marketing Research found that approximately 8% of all interest ever paid on credit cards is due to this minimum payment effect. Let's break down what this means for the average college student with $3,280 in credit card debt. At 18% interest with a 2% minimum payment, it would take over 30 years to pay off the debt and cost nearly $10,000 in interest. That's 3 times the original balance paid just in interest. That $50 dinner and drinks you put on your card freshman year, you could still be paying for it after you have kids in college yourself. The practice of targeting college students was relatively restrained until the 1980s and 90s. Then everything changed. In a landmark Supreme Court decision called Marquette National Bank v. First of Omaha Service Corp., Credit card companies gained the ability to export high interest rates from states with no usury laws to states that had strict limits. Suddenly, a credit card issued from South Dakota could charge whatever interest rate it wanted, regardless of where the customer lived. This triggered a race to the bottom, with banks competing to offer the most predatory terms. By the early 2000s, the targeting of college students had reached predatory levels. Companies would set up tables directly on campus, offering free merchandise to students who applied, even knowing many had no income or ability to repay. When I started college, I was pre-approved for almost anything, says Ashley, now 32 and still paying off debt she accumulated as a freshman. I had no job, no income, and no clue what I was getting into. Nobody warned me that the free t-shirt would end up costing me thousands. What makes this particularly manipulative is that credit card companies know exactly what they're doing. Internal industry documents revealed during congressional hearings showed that card issuers were well aware that many student applicants had no reliable income source. Today's college students primarily use their credit cards for online shopping, 70.1%, and dining, 50%. These aren't emergency expenses. They're everyday purchases that could easily be made with debit cards or cash. Credit card companies specifically design their marketing to normalize using credit for routine expenses, promising rewards and cash back that make debt seem like a smart financial choice. Financial expert Dave Ramsey puts it bluntly,
$1 trillion of you buying crap you can't afford with money you don't have to impress people you don't even really like. Maybe you should stop that.
Credit card debt is a trap, and students are one of the biggest targets. The best way to win with money is to avoid debt altogether. The psychological impact is real. Financial stress has been found to be a significant source of anxiety for college students, affecting both academic performance and overall well-being. 53% of students report that credit card debt causes them more worry than any other type of debt, including student loans. In 2009, recognizing these predatory practices, Congress passed the Credit Card Act. It required those under 21 to have a co-signer or prove income and prohibited tangible gifts on campus as application incentives. But the industry quickly adapted. Companies simply moved their marketing tables just off campus. They shifted to digital targeting through social media and email. They found creative ways to continue offering incentives that didn't technically violate the law. As CNBC reports, credit card companies are now prohibited from staying at least 1,000 feet away from college campuses if they are going to offer sign-up gifts to students. But what about the emails flooding student inboxes or the targeted ads following them across social media? The most concerning loophole remains the official university partnerships. By working directly with schools and alumni associations, credit card companies gain an implied endorsement that lends credibility to their products. Today, there are 143 identified partnerships between colleges, alumni associations, and credit card issuers. The 12 largest partnerships represent over 530,000 open accounts. The targeting of college students isn't just business. It's a calculated effort to capitalize on financial inexperience at a vulnerable life stage. By understanding these psychological tactics, particularly the minimum payment trap, students can better protect themselves from becoming lifelong profit centers for the credit industry. The difference between making minimum payments and paying balances in full is the difference between financial freedom and decades of servitude to credit card companies. Universities have a responsibility to protect their students, not profit from their financial vulnerability, and credit card companies need to be held accountable for targeting those who they know cannot afford to repay. The next time you see a credit card company offering something for free on campus, remember, the most expensive things in life are the ones that claim to cost nothing. This trap has been set for decades, and it won't stop until we demand better regulations and more accountability. If you found this video eye-opening, hit the subscribe button and share it with someone who needs to hear this. And drop a comment below if you've experienced predatory credit card marketing as a student. Thanks for watching. Remember, knowledge is your best defense in a world designed to profit from your debt. I'll see you in the next one.